So how mortgages works is you have a pool of investors and they lend money to the main investors, which are Fannie Mae, Freddie Mac, they're securities. So they're lending money to these securities. And of course, they're going to charge their return, which is known as their yield. So they're saying, okay, we're going to give you X amount of dollars that you get to lend out, but we want a 5.5% rate of return. Let's say that's what it is. And then Fannie, Freddie, and Ginnie, which are securities, say, okay, we're going to take this 5.5 and we're going to, or this money that we're paying a 5.5, and we're going to lend that out to the banks. So they then lend the money out to the banks and they charge their premium. So let's say that's a 1/4 point. Well, now that 5.5 is now 5.75 that's passed on to the lenders, if you will. Then the lenders are going to decide how much they want to put in a fee before it goes to the consumers. So that's why sometimes you could see a bit of a variance, as it can be, depending on what the company is trying to accomplish. Are they just trying to get volume? Are they trying to make profit? So it could vary a little bit based on those dynamics. Now, once this, 5 to 5.75, and let's say it's only a 1/4, well, now you get a 6% rate. So that's how mortgages work, is it goes in a cycle of investors and backers, and actually a lot of consumers are investors of those too. Now, these are just blanket example numbers, but I want you to understand how it works. So what's different about me as a broker is that it's not just Wells Fargo, it's not just Chase and whatever they plan to give you that day to lock in. I get to go in and shop over 60 different brokers to ensure that, or wholesale lenders, to ensure that you're getting the best price based on what they're giving, because it's fluctuating and changing every day. So I go in, put all your information in, I shop all of these wholesale lenders, and we figure out who's going to give the best pricing based on your specific dynamics. So hopefully that gives you a little bit more insight on here. So that's what I've been doing. I've been shopping all of those lenders to make sure, based on your specific qualifications, that we get you the best options, because I think it's really important that you understand the behind the scenes based on your specific options and rate, and be fully transparent so that you know that you're getting the best options possible with great service in mind. This is known as mortgage-backed securities, and this is where we're going to be able to track and see what's going on with the market, and that's what indicates interest rates. So to give you perspective, I'm going to give you a high overview of this. When mortgage bonds are trading high, it means that mortgage interest rates are low. And when mortgage bonds are trading low, it means that mortgage rates are higher. So rates, you probably remember rates were back in the 2s in May of 2021. And then we see a dip, and we got just over 3%. And then they were up, down, not too far off. And then in January of this year, we start to see a very aggressive nosedive, and it's pretty steep. So in June, you see there's a low point where they got to 5s and then 6s. And I share this with you because you may have seen someone else get a lower rate, or because you've seen rates go up and down, and they may have bought the rates when the rates were doing better, or their parameters may have been different. So consumers can't control this, and it's been a huge impact to the rate that you get that's fluctuating. So keep in mind, you're not marrying the home, or you're not marrying the rate, you're just marrying the home. And what I mean by that is you're buying the home for the price that you get, but your interest rate isn't, something that you have to keep long term. So, maybe in a year or two, home prices are going to be higher, and no matter if they go up, you bought at today's price, so you get the appreciation. But you're dating the rate, which means that if the rates drop in the future, which they have always followed in a cycle, you're going to get the opportunity to get a better rate at no cost. So for all my clients, I monitor your rate at no cost to you. If we're in a position that we could do a no cost refinance in the future as rates get better, I'm going to be reaching out to you, letting you know. As a returning client, we can look at those options as a no cost refinance for you in the future as well. So even if you're servicing, which is who you make your mortgage payment to after closing changes, I'm still going to monitor your mortgage and be able to provide you all that information. And you're going to be getting an equity report every single month that shows kind of a trend of your value. It's not 100% accurate because it is just online monitoring, but it's going to give you really good information that you can follow month over month and kind of look at some different things to make sure you're in the best position possible. So another thing that we're going to be looking at specifically to you is going to be, your interest rates. And so there are, 30 different adjustments to rates. Now, we talked about how the money flow works. So these investors are the ones that actually make up the guidelines and the adjustments to the rates, because they're the securities. So they're saying, okay, we're going to lend you this money, but they have to match these parameters. And if it's a higher risk, if you will, it has what's called a lender price adjustment. that's attached to your rate. So there's like a starting rate, and then based on all of these factors, it then can have adjustments that are increases to your rate based on those adjustments. So loan amount, loan term, how much money you're putting down, the type of property, your approval, your credit score, your debt to income ratio, reserves, how much funds you have. All of these factors are going to make up what I call your specific scorecard. So what your scorecard means, and what I'm going to show you here in a snippet, is that, I kind of took your rate cards here. And as a, certified mortgage and liability advisor, this part is really fun for me because most lenders don't show you this stuff. And loan officers, work for the banks, don't even know how this works. So as a broker, and I get to shop all these banks, I get to get you the best rate options and shop these rate boards. And I think every consumer should understand how this works because every scorecard is specific to you. This shows based on the bond market today, you get to choose your rate. You can go with a lower rate, which is higher cost, or you can go with a higher rate, lower cost. So you get to decide. So I put in all of the parameters. I get the best options, best wholesale lender for you. And then we look at the scorecard for that lender to determine what specific rate you want for you. So marketing, keep in mind, wants you to see the lower rate, but beneath it in the paragraph, when you look at the marketing, you got to look at the date. They're usually quoting a date back when rates were lower. Also the conditions that you have to meet. So typically, a high credit score, 40% down, and then also paying points. So that's what you would be paying here. They're called discount points to get a lower rate. So they may quote you a lower rate, and then you read the fine print and realize that, oh, they are charging, those fees in there too. So what I do is I take your specific options and I'll show you the top few that we need to consider that make the most sense. And then we review these so that you can see which one is going to be the best option for you.